All right, we are live. So welcome back to Dapp University. So today we got a lot to talk about in our live stream. We're going to talk about why today could be a crazy day for crypto. Okay, we're going to look at that. We're going to look at live other news updates that have happened in the space since our live stream yesterday. Again, we do these live streams Monday through Friday on this channel. We're going to actually look at the crypto markets, answer some of your questions, and a whole lot more. So if you're new around here, hey, I'm Gregory, and on this channel, I turn you into a blockchain master. So if that's something that you're interested in, then smash that like button down below for the YouTube algorithm and subscribe to this channel. And if you want to learn how to become a blockchain master step-by-step start to finish, then head on over to dappuniversity.com/bootcamp to get started today. So we got people jumping in the chat here. We've got Dale, Kodia, Above Realty, Automatic Beats, Mark, Jay Lee, From Riley, Alden, Stefan, Decibel, I'm saying that right, Sunil, Technically Alpha, Eileen, Frank, welcome. All right, so let's jump into this. Let's talk about today and why this could be a crazy day for crypto. And actually, let me check my YouTube live stream here, make sure I put the right thumbnail in the live stream here. Yeah, so we're good. All right, so, crypto has been in this crazy, bearish trend pretty much all year, right? And the big reason for this is definitely what's going on with the monetary policy shift in the United States, okay? Crypto has been on the same downtrend that the stock market has been. Pretty much all assets have been in the same trajectory, okay? Pretty much anytime the stock market moves to the downside, we see crypto follow suit, okay? When these two things look like one another, it's usually one of the following. Either it's one's following the other, they're influenced by the same thing, or it's a complete coincidence. And it doesn't take a genius to see that really it's the same thing influencing pretty much everything, which is what's been happening with the central bank's monetary policy, particularly in the United States, okay? So basically, at the end of last year, the Federal Reserve decided to start raising interest rates to start, on the trajectory of quantitative tightening rather than quantitative easing. Is one of the fastest, U-turns, one of the fastest 180s in monetary policy we've seen in a very long time, mostly because of inflation, okay? So that's been the big boogeyman floating around pretty much every single circle, even outside of crypto. It's one of the most talked about political issues. Again, I don't pretend to be a macroeconomics expert by any stretch of the imagination on this channel, but, you don't have to go very far. You can pretty much walk on the road to any conversation and, into a restaurant, let's say. And I bet you if you listen hard enough, somebody will be talking about inflation, or somebody will make a mention of some price or something like that. It's one of the most talked about political issues. So anyways, all eyes are on inflation, particularly with the Fed. And that's one of the reasons we've been seeing the rate hikes is to essentially try to curb inflation. One of the reasons we've seen quantitative tightening, okay? And today we have the FOMC meeting that's going to give us an indication on what the Fed thinks about the direction of inflation, what they plan to do in terms of their next rate hike increase, and also what their forecast is for the coming months, okay? So anytime we have an event like this, it typically has some sort of impact on pretty much all financial markets, including crypto. Okay, whenever we have one of these FOMC meetings, we typically see some volatility in the crypto price, and I do not think that today is going to be an exception to that. Of course, we'll have to wait and see. It's not financial advice. I'm not telling you to buy or sell any cryptocurrency based on this information, but this is what you need to know. Okay, so let's kind of break that down. So basically, the Federal Open Market Committee, or FOMC, okay, meets on a regular schedule throughout the year. It's just a 2-day thing. And then at the end of their meeting, they release their report basically to the public. That's going to happen today at 2 p.m. Eastern Time, followed by a speech from Jerome Powell at 2:30 Eastern Time, I believe is the right time. So you can convert that to whatever time zone you're in. And typically, initially upon the release of the report, we typically see some type of market move. And then also, whenever Powell is speaking, we usually see some type of volatility because people are trying to decode exactly what he's saying and what that means for the future. So why is that the case? Well, basically, people are just really, really, really waiting to see, are we going to continue going down even more harshly into this, tight monetary environment with high interest rates, less money flowing through the economy, especially into assets, right? I'm sort of treating this like pretty much every FOMC meeting, I'm treating like Groundhog Day. Okay, so if you know what Groundhog Day is, we're basically like waiting for the groundhog to come out of the hole to find out like if he's scared of a shadow and whether we're going to have 6 more weeks of winter. Okay, this is the same type of thing. In fact, somebody out there needs to make a meme and tag me on Twitter of like a Groundhog Day with Jerome Powell on it or something like that. Or maybe he's holding the groundhog. We won't be too disrespectful there. But anyways, yeah, that's how I'm treating this, right? So we're all kind of waiting to see what the groundhog does. Is it scared of a shadow? Are we going to get 6 more weeks of winter? Or is it going to stay out of its hole and then we get spring early? So that's sort of the idea here. So let's talk about the rate hikes because essentially, we've seen the most aggressive rate hikes pretty much ever this year. Okay, pardon me just one second. Hold on. I've got really bad allergies right now. So we've seen some most aggressive rate hikes ever this year. Okay, we started off kind of easing into things with a 25 basis point rate hike. In case you're not familiar with what rate hikes are, basically this is the federal funds rate. Okay, so this is basically the rate that banks are going to lend money to one another. This has a pretty big impact on other rates. Okay, so basically whatever the Fed does with their federal funds rate, it influences many other rates like bond yields, like mortgages, like other type of stuff. People have this misconception all the time that the Fed like sets mortgage rates. They don't really do that, but the federal funds rate and their other policies highly influence other people's behavior, which then impacts mortgage rates and other things as well. So that's one thing to understand. Also, it changes how businesses borrow money, whether they want to go into riskier endeavors. Okay, it changes the cost of debt. And that's why you see things like the stock market go down. You see repricing of valuations, especially for growth-based businesses, all right, people who rely pretty heavily on debt, and the correlation with the general risk-off attitude, which is why this hits crypto so hard, okay? So anyways, we started easing into this with, 25 basis point rate hikes. Those quickly rose to 50 basis point rate hikes, up to 75 basis point rate hikes. And now people are kind of scratching their heads going, are we going to see a 100 basis point rate hike? So what does that mean? Well, basically, let me just pull up a note here. So I'll put this on my screen. So what is a basis point in case you're not familiar? So let's say an interest rate is 5%. Okay, a basis point is 1/10 of 1%. So 25 basis points will be, if 25 basis point increase from 5% would be 5.25%. Okay, it's called a basis point because it gets confusing. If I said, let's say if you're at 1% and I say a 25% increase, that's easy to understand, right? Well, it's ambiguous, right? A 25% increase from 1% is 1.25%, but if a 20% increase from 5%, right, off the top of my head would be 6%, right? But to disambiguate that, you just say 100 basis points because you're talking about a full percentage point rather than saying and also it's confusing. So anyways, that's the terminology. So that's what I mean by 25 basis point rate hikes versus 50 versus 75 versus 100. So the real question today is how fast are they going to hike? So, and also, what is that relative to other people's expectations? So basically, it looks like the consensus among many people is that a 75 basis point hike will occur. Okay, so basically 0.75%. All right. But there's a lot of people who think there might be 100 basis point or a full percentage point increase. So that's a minority position, but there's still an overwhelming number of people who actually think that compared to if you'd said that a year ago, you would be absolutely crazy. So you got to think about that in multiple ways. And, you've got to also understand that a year ago, if people were expecting a 75 basis point hike and are relieved if we get it, that would also be crazy, okay? And by the same token, if you heard people say that inflation was 8% and they're happy about that number, that you've also said you're crazy, right? So why is that? Well, a lot of it's got to do with people's expectations, okay? And that's really what could affect the volatility here in the next several hours, today in particular. So, that's end of the day, markets don't like uncertainty. Once it set its expectations and things follow its expectations or is better than its expectations, then that's, for lack of a better word, good. All right. But when things defy expectations, particularly when things are worse than what people expect, that's when things get kind of bad. Okay. So that's what to watch out for today. Do we get the 75 basis point hike that is largely in people's expectations, or do we see a more aggressive rate hike from the Fed? Okay. So that's the first thing to watch out for. Okay. Now, the other thing to watch out for is definitely that speech that happens directly after, because it's not just about the numbers. It's not just about what they decide to do for the next hike. It's also basically what is the content of that speech? What is the general tone of it? What is the subtext of what is being said there? Okay. To try to get an idea on what the market thinks that the next several months looks like for the economy, and more importantly, what the central bank plans to do in response to that, which will likely have a very big impact on the economy itself, and also for financial assets, also, putting crypto underneath that umbrella. So that's a whole category in of itself of, Fed speak and people interpreting Fed speak. Definitely not planning to be an expert on any type of that, but that's what we'll likely see some volatility around as well during that presentation. Okay. So one view here is that hawkish expectations leave the door open for a relief rally. Basically, since last week's CPI release, markets have been hawkish, repricing of Fed expectations. So basically, we saw inflation data come in hotter than expected a few weeks ago. That's one of the reasons we've seen the market kind of sell off. All right. The interest rates currently stand between 2.25% and 2.5%, and the current betting is borrowing cost to peak around 4.5%. All right. And so basically, we're trying to get those numbers up there. The question is how fast we're going to do it. So if the interest dot plot is basically a graphical representation of each Fed official's projection for the benchmark interest rate, and the Fed comments match market expectations, risk assets will likely bounce. That's what I was talking about. Basically, if people meet people's expectations, that's baseline, for lack of a better word, good news. So because people have these low hawkish expectations, if we just meet expectations, we exceed them, then expect some volatility to the upside. Now, if things are worse, just like the CPI numbers, even if it's slightly worse, I would expect some downside from this. So let me know what y'all think down in the comment below. Somebody says 100 today. Could be. Somebody says, somebody's saying to like the video. Yeah, definitely like the video. Somebody says shorts are in. Yeah, the shorts might be in. Alex thinks it's going to be 75 basis point. What time is the DXY going to change today? Do I estimate? Let's actually check on the DXY. We're still above 100. Let's check. I don't watch it every day, but I'm going to check out my screen here. We're basically at a local high still. It's so crazy. Again, I don't pretend to be a macro expert by any stretch of the imagination, but I do watch, generally speaking, what's happening in other areas. I watch interest rates. I watch stuff like the DXY. If you're not familiar with the DXY is, it's the U.S. dollar index. It basically measures the strength of the dollar relative to the basket of other currencies. Okay. Not everybody loves using this as a metric because the weightings and how things are going to. Again, do not pretend to be an expert at all, and trying to use this as a tool for forecasting anything in the future. Okay, but I do watch this as a data point, try to see what is happening, try to make sense of the current environment, because you typically see like an inverse relationship between things like the DXY and risk assets, things like Bitcoin. Part of it is a general indication of like where do people want to put their money, and right now the dollar is relatively strong compared to many other things. Now you might say, well, it's losing to inflation. Yeah, that's true, but like, what's the alternative for a lot of people? Okay, you have to have future expectations and have a longer time preference in order to want to keep putting money into other assets that you expect to appreciate over long periods of time. So anyways, that's what's going on with the U.S. dollar index. I mean, it's basically at a local high on a past year. If I look at on the 3-year time frame, I think I'm trying to think of where our previous high was. So the last major high was basically during the .com fiasco back in 2001. I can't even read the number because it doesn't come on my chart. Okay, so a couple of things I want to talk about. Stable coins have been a pretty big source of drama throughout the entire crypto space. Of course, we saw the Terra Luna disaster earlier this year. Basically, we saw the algorithmic stablecoin absolutely blow up. We saw that was UST. We saw Luna, the cryptocurrency itself behind the blockchain. It was a top 10 coin, basically go to zero. Okay, this was a major event that exacerbated the crypto sell-off that was already happening. All right, highly influenced by the broader economy. But we had some crypto-specific issues, some funds blowing up, contagion risk, all that type of stuff. Okay, and we're starting to see a House bill drafted in the United States, okay, with some stablecoin regulation inside of it. So, a pretty common takeaway from the stablecoin disasters was that we would likely see regulators come for stablecoins pretty quickly, and it looks like that's what's happening. Okay, so we're starting to follow the initial development of this. Basically, you can see this from the block. Basically, a draft stablecoin bill in Congress requires to require Fed state regulator approval. But basically, we can look at some initial language inside of here. Issuing stablecoins without approval from appropriate regulators could be punishable by up to 5 years in prison and $1 million fine. Okay, so it's probably a good thing they added. Well, again, I'm assuming that you're trying to accomplish your mission from a regulator standpoint. It's probably good they added the jail time on there, because I don't think many people who create stablecoins are going to care about paying $1 million fine if they can make a lot more than that. So we can look at some other regulations. Again, if you watch this channel, you sort of know my opinion on regulations, but I'll restate that here in a minute. Anyways, the House stablecoin bill would put a 2-year ban on algorithmic stablecoins. So draft seen by Bloomberg. Under the current draft of the bill, it would be illegal to issue or create new endogenously collateralized stablecoins. So, yeah, really no surprise here, in my opinion, that we're starting to see this regulation come so quickly. Again, this is not passed. Okay, this is just a draft in the House. It has to go through several steps before this would actually become official. Okay. And even if it became official, it may not be immediate action or immediately effective because we don't have all the details yet. But, again, my opinion on regulations are this. I mean, I think there'll be people who disagree with me on this, but I think that crypto can exist just fine without regulations, like it basically already does. I know a lot of people lost their shirt in the Luna stuff. If that was you and were affected, we've talked about this a lot on this channel, that I don't want anything bad to happen, okay, for anybody on this type of thing. However, I do think that the regulations that intend to protect other people oftentimes have unintended consequences that really end up being a net negative for the ecosystem that gets regulated in general. Okay, so that's sort of my view on the regulations, that crypto can really exist just fine without them. However, I am a realist in thinking that the regulations are going to come, and there's really nothing I can do about it, even if I think we don't necessarily need them. So what's my response to that? Well, basically my response is to try to get the most favorable regulations possible, realizing they're probably inevitable. So that looks like, being in dialogue with regulators and trying to essentially, push back when they overstep their reach, and try to work with, and also fund people in the space who are, competent at getting things done, particularly in Washington. So that's my view. Again, no surprises that we're seeing these type of regulations so soon. Hopefully, it will be as favorable as possible. Somebody says sponsored by the exchanges, LOL. Well, that's the other thing. I mean, this is where I think exchanges can actually be a pretty big asset to the ecosystem, because a lot of the exchanges have connections. Oh, I say a lot. Some of the exchanges, some of the big ones have connections. They have funding, and it's in their best long-term interest to keep the crypto space as free and open as possible. I mean, we've seen people like Brian Armstrong come out from Coinbase talking about how they would, essentially fight against censorship on protocols like Ethereum, with like the OFAC sanctions and stuff. And honestly, like I'm gonna take that at face value and not as like a lie, basically. I think there's some people who essentially were sort of fading that and say, oh, that's just, he's being disingenuous, like he's just saying that as a PR thing. I don't really think so, because Coinbase has been a pretty OG player in the space. I know there's people who get like upset because they've had customer support issues, maybe with like depositing or withdrawing, or accessing funds, or being able to execute orders or something like that. Like that's an operational thing, okay? I'm talking about they have massive incentives to see the crypto space succeed, and preserving the ethos of the crypto space is in their best long-term interest. And I really do think that they would fight for that type of thing, even at their own short-term expense, because I do believe that Coinbase is playing long-term games, not short-term games. So this could be a situation where, they actually could be a pretty big asset in helping fight for favorable regulation in the crypto space. So Brandon says the Swiss franc has been really strong as of late, has avoided most rate hikes alongside the Fed. However, they are planning a 100 basis point hike this week. Article on FX Street. Somebody says, is DAI an endogenously collateralized stablecoin? No, it's not, because you have to mint DAI. So let's look up the definition. Endogenous. So proceeding from within, derived internally, basically growing or developing from within. They're talking about algorithmic stablecoins, things that keep their peg based upon an internal mechanism. But with DAI, you have to collateralize it. Okay, you have to basically mint DAI and backed by other crypto assets, and the value of DAI is a fraction of the collateral value. That's what keeps it safe from liquidation. So it's not the same thing. I don't think that DAI would fall under endogenous collateralization. It's manual collateralization. There is some sort of automatic mechanism that helps preserve the peg, but that's not automatically collateralized. I mean, again, that's not fun. Of course, that's not legal or financial advice. They could try to make some sort of case that it's this, just like they could try to make that Ether is now a security because proof of stake has been turned on. I don't think so, right? But you could have some regulator, decide to say it is, because they don't actually see what it's used for. So one of the things I want to talk about is we talked about the Wintermute hack that happened yesterday, and I want to follow up on that a little bit. Okay, so basically we saw the Wintermute market making firm. Okay. Have $160 million compromised. Again, this was not part of their OTC operation. This is just for their DeFi operation. Okay. So basically what happened was they had an address that was not as secure as it could have been. Okay. So there is there's a tool called Profanity, okay, that basically lets you generate addresses that look different from most blockchain addresses, okay? So I'll show you what I mean by that. So basically, like, I'm just going to show some sort of random address here on the blockchain. So I literally just pull up Etherscan and found a random address. So like this address right here, you can see their address up in the top right corner. It's this like superhuman, like you can't even really read this. Like if I try to dictate this to you, you'd get really confused. It's like an epically long phone number basically with a 0x in front of it and letters. So in order to like combat this problem, you got a couple solutions. You could do an ENS name. All right, you could register a .eth name or something, or you'll see some people who will like put a bunch of trailing zeros inside of here, and then only have like have basically a vanity address that's really easy to read and understand. Okay, and so that's what the Profanity project is for. Of course, it's been archived and is definitely deprecated and not recommended to use anymore, because basically they're way more easily cracked. Okay, so basically because you're generating that shorter key. Okay, one GPU can do 7 symbols for 1 second. This means that 1,000 GPUs can brute force the 7-symbol vanity address in 50 days. Okay. So this could cost a lot, but the reward could be much higher. Moreover, the reward could be pre-estimated. So basically, you could look at every single address in the Ethereum network that essentially implements a 7-symbol vanity address. Okay, basically all the 7-symbol vanity addresses could be brute forced in 50 days with 1,000 GPUs. Like he's saying, that's going to be expensive to acquire 1,000 GPUs. It's also going to be expensive to run the electricity, but the upside could be worth it for the attacker. And that's basically what they did. So we saw that confirmed from Wintermute themselves. So basically a quick update on the Wintermute hack is I would like to share more details on what happened. The attack was in relation to our wallet used for DeFi proprietary trading operations, which are completely separated, independent from our CeFi OTC operations. Basically, our internal systems are not affected, blah, 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 blah. But the attack was linked to the Profanity type exploit of our DeFi trading wallet. So he was saying that we did use Profanity as an internal tool to generate addresses with many zeros in front. Our reason behind this was gas optimization, not vanity. So we'll just take that one at face value. Okay. Last time we generated addresses this way was in June. We have since moved to a more secure key generation script. We learned the Profanity exploit last week. We accelerated the old key retirement, and then due to an internal human error, a wrong function has been called, and we blacklisted the router instead of the operator. Contract the signs. Basically, in that roundabout way, it led to the exploit that we saw in the past few days with $160 million gone. So what can you learn from this? Don't generate addresses with 7 characters. Don't use Profanity. That's the lesson. Don't use Profanity. Sound like your middle school teacher. All right, everybody. Let me know something in the comment section below. What kind of radar we're going to see today from the central bank. Again, keep your eye on this. This is going to happen later today at 2 p.m. Eastern is the report release, and then 2:30 Eastern is going to be the speech. Let's see what happens. So that's all I got for today. As always, smash that like button down below for the YouTube algorithm. Subscribe to this channel if you haven't already. That really helps these videos out so that the more people can learn about blockchain. And if you're as fascinated with this technology as I am, you want to get your hands dirty, how can you get started today? You can go to my YouTube homepage. You can find those free courses there. They're like Udemy courses, but they're totally free. And if you like those and you want to take the next step, or hey, maybe you want to take a massive shortcut entirely, I can show you how to master blockchain step-by-step from start to finish over at dappuniversity.com/bootcamp. You don't have to be an expert to get started today. I've helped people with zero coding experience become real-world blockchain developers in a matter of months. So that's all I've got. Until next time.